Welcome to World DNA. This is the part 4 of our advanced option strategies course, and in this part we are going to discuss a bearish credit strategy, that is bear call spread. So this is our advanced option strategies course, and you can find other strategies in the similar playlist on our page. So let us begin. So disclaimer, important one. All the information provided here is for information and education purposes only. Kindly do consult your financial advisor before taking any trades. So strategy number 4, bear call spread. So as the name suggests, this is a bearish strategy, and at this is a bearish strategy which involves calls. So naturally this strategy is a credit strategy, that means it involves selling call options. This is again a direction strategy. So the difficulty level, this strategy should be implemented by those traders who have some prior experience in options, because this is a net credit strategy and the maximum loss is way more than the maximum profit in these kind of strategies. So the profit level is limited to the net premium received, and the risk level is also limited. So let's move ahead. So what is actually bear call spread and when to use it? So bear call spread is a credit strategy which involves selling at the money or slight out the money call option and buying further out of the money call option. So let's say if a stock is trading at $100 and you are hoping that this stock is going to fall to, let's say, $90. So what you can do, you can sell $100 call option. You can sell $100 call option, and in order to protect your upside, supposedly if this stock instead of falling go up, what you can do, you can buy further out of the money call option in order to limit your upside losses and reduce your reduce your margin requirements. So when this strategy should be used, when you expect a stock to fall or remain sideways until expiry. You are hoping that the market will go down steadily and it will not go beyond a certain level of resistance. So selling at the money or slightly out of the money call options helps in playing bear market, and buying further out of the money call options provides a hedge in case market moves upside. So this strategy should be used when you are moderately bearish on a stock and you are hoping that this stock will not rise beyond a certain level of resistance. So this is the bear call spread and the conditions which are good for bear call spread. So this is a pictorial example of bear call spread. This person is looking at a stock of $100 and he is hoping that this stock is going to fall, but also he does not want to sell naked call option. What should he do? What he can do, so he sold a call option for $100 strike price at $3 per option and bought $105 call option for a $1 per option. So he received a net premium of $200. $3 collected from $100 option and paid $1 for 105 strike price. So $2 net received for a 100 lot. So he received a net premium of $200. This is his max profit, because in credit strategy you cannot earn more than your maximum premium received. So what would be the profit and loss situation? So in case stock do fall, so in case the stock falls and it go less than $100, both the option expired $0 and his maximum profit is limited to $200. So this is a very simple one. In case stock really falls and it expire below $100, both the options will expire worthless and he can keep all the premium received. Second scenario, in case stock instead of falling rise to $102. So why this $102? Because he received a net premium of $2. So what would happen in this situation? $100 call option will expire at $2 and $105 call option will expire at $0. So his PNL will be nil, no profit, no loss, because now he is required to pay $2 to the option buyer. But what would happen in case stock moves to $105, that is the strike price of his sold option? He will lose $300 because now he is required to pay $5 to $100 call option buyer, and his loss is $300, $5 paid and $2 earlier collected. What would happen in case price rise to $110? Remember, as this strategy involves selling and buying, his loss is also limited beyond the strike price of sold call option. So in case stock do rises to $110, he cannot lose more than $300 because after $105 this call option will kick in and it will start gaining to price. So this was the example and profit and loss scenario of bear call spread. So what are the Greeks of bear call spread? So in case you understand, you don't understand about Greeks, or you just have a basic knowledge of Greeks, I do recommend you to watch our previous playlist of Greeks, wherein you can get the knowledge of advanced Greeks, how the Greeks are played by professional traders. So I do recommend you to kindly watch our previous playlist on Greeks. So what are the initial Greeks of this bear call strategy? The delta is negative, that means you want the stock to fall. The gamma is negative, that means any upside move will create problem for your strategy, because this is a net credit strategy. Any gapping move on upside, because you have sold call option, any gapping move on upside will create problem for your trade. Theta is of course positive, because this is a credit strategy. If nothing happens and day passes, you will earn daily decay. What about Vega? If the IV goes down, it will be profitable for your position because it is a net credit strategy. So these are the initial Greeks of bear call spread. So how bear call spread is earns or loses? So this is the typical payoff chart of a bear call spread. So this is the break even point, that is the strike price of call sold plus premium collected. In our example, this would be the $102. So this is the $102 break even point. So as you can look in this payoff chart, as the stock started to rise, your position will start to lose, and at this point, for which you have bought call option, that is $105, beyond this point your loss is limited. And how this strategy will earn? This strategy will start to earn once this stock fall beyond $102. So this strategy will start to earn, and it will not earn more than the net premium collected, that is $200 in our example. So this is the typical payoff chart of the bear call spread. Maximum profit is limited to net premium collected, and maximum loss is always greater than max profit because it is a credit strategy. So this is the typical payoff chart of bear call spread. So this is an important part, how the bear call spread is adjusted. Trades and direction do goes wrong. We are hoping that this stock will fall, but instead of falling, this stock started to rise. So what should you do in such a situation? So it totally depends. Adjustments are totally dependent upon your conviction. If you are still hoping that this stock is going to fall, then you have to adjust it differently. And in case you are hoping that this stock is not going to fall, rather it is going to break all the barriers and just go up and up, so in that case you can adjust it differently. So it's all depend upon what is your conviction, what you are next hoping for the stock to do. So as this is a credit strategy, max loss is always greater than maximum profit. And in most of the cases, if you are unsure about the direction of the stock, the trade should be closed when the market moves in upside direction. So first preference should be given for no adjustment. In case you are not confident on a stock, just close the trade and take your money out. However, you can still make some adjustment based upon your conviction. So case one, you are not now, you are not bearish anymore. You don't think that this stock is going to fall. You are not certain what this stock is going to do. So what should you do? Take the losses, close the trade. So when uncertain, close it. Trade should be closed. The second case, now instead of bearish, you are now betting on bullish side. No, you hope that this stock was trading at $100, it was its resistance level and it somehow broke its resistance level. Now you are hoping that instead of falling, this stock is going to rise. So how you can adjust this strategy? You can buy more out the money call option that you have bought in first place to make it a slightly debit or less credit strategy. So in original example, what we have done, we have sold $100 call option and we bought $105 call option. So what you can do, you can buy one more lot of this call option. What this will do, this will make your payoff chart like this. It will protect your downside profits and it will open your upside profit. So buying more out of the money put call option helps in playing you bull market run. So this is the adjustment which you can convert your bear trade into bullish trade. And you can see in this payoff chart your maximum loss is also limited on the downside. So you can earn on downside, you can earn on upside. However, you are playing on bullish trade, so there is more upside profit in this strategy. So this is the first strategy that one can implement in bear call spreads. So there is another situation also. So you are still bearish on this stock and want to protect upside. So this stock goes up, but you are hoping that this is a false breakout and you are still bearish on this stock. However, you want to protect your upside. What you can do, you can sell put options for a certain level of support. It will protect your upside because you collected more premium now. However, it will open your downside losses beyond sold put option. So this this adjustment should be implemented when you are a pro trader or you have very much experience in handling the trades, and this will require a hefty margin requirement. So this adjustment should be implemented only by professional traders, and I will not recommend any retail or small trader to implement this adjustment. However, retail traders can implement this strategy because this reduces your margin requirement rather than increasing it. So this was the adjustment of bear call spread. Hope you have understood it. So this is how our bear call spread strategy is concluded. In case of any query, kindly do comment below, and I request all of you to kindly do subscribe our channel for new upcoming strategies. And in case you like, you can visit our website boldDNA.tk where you get free volatility charts and market analysis. Also, you can also follow us on Twitter at WolBusy, where we post daily updates on financial markets and emerging opportunities in the market. So thank you for the watching.